full session this evening. This is the third live session that we're having. The one we had on Friday, which we did, was lesson 3. Then we did Sunday was lesson 7, and tonight we're going to do lesson 8 and 9, which is still substantive procedures, both lessons. The one is just understanding what substantive procedures is, which is lesson 8, and then 9 would go more into the detail of the lesson. And then I actually have the last slide is the other considerations for audit evidence, which is lesson 10. But I was thinking, if you want me to go through more on lesson 10 tomorrow evening, I can. And then but tomorrow's evening session should be around any questions you might have or any burning things you want to ask me. And we can then have a live session for that tomorrow. Is everyone in agreement? I hope everyone's in agreement.
Yes.
Okay, and then I'm not sure if you all know, but you have a session with your lecturers on the 17th of July. I think it's from noon till 2, if I'm not mistaken. You must just go check under their announcements on the lectures UNISA site. Okay, so like I said, we're doing this live session, which is number 3, and we're going to do the substantive procedures, business cycles, and other audit considerations. So the purpose is basically to equip all of you guys with the knowledge and practical guidelines to formulate substantive audit procedures across the various business cycles that you get, right? And just to recall, remember on Sunday when I spoke about test of controls, we said that is in stage 3, that is obtaining audit evidence. So substantive procedures is still within stage 3 of the audit process. So it's still in the obtaining of audit evidence so that you can basically respond to further risk within the audit, right? So the learning outcomes for this evening is to understand the principles of substantive procedures, because it's basically, like I said on Sunday night, or was it on Friday, where the student asked me, what is the difference between test of details and analytical procedures, is that both of them are substantive procedures. As a substantive procedures is split into the two, so you'll get a better understanding of the two. And then, of course, to looking at substantive procedures using computer-assisted audit techniques, which is CARTs. Then you have to also look at formulating sufficient appropriate tests of detail as well as substantive audit or substantive analytical procedures in order to be able to score those marks when it comes to your substantive procedures, and then formulate procedures based on the key assertions relating to all 5 of the business cycles, which is revenue and receipt cycle, acquisition and payment cycle, the inventory and production cycle, as well as the payroll and personnel cycle, and last cycle is the finance and investment cycle. So those 5 cycles, we went through a bit of those 5 cycles in the test of controls session on Sunday evening. So I'm not sure if you remember, but in that session I spoke about these different flows or different like stages within each cycle to get to, like for example, in order for revenue to be recorded in the financial statements, a customer first have to place an order, and then the goods must be picked and the goods must be dispatched and delivered and so forth. So there's different stages, and as a student, when you're creating substantive procedures, it's important to know, first of all, which cycle you're dealing with. And then once you know which cycle you're dealing with, one of the 5, then you must know which process or flow am I in. And then you also know which source documents is within that cycle for you to be able to audit it or to do substantive procedures. Then like I said, the last would be understanding other considerations around audit evidence, such as making use of an audit management expert or auditor's expert, um, as well as accounting estimates and related parties. So what are substantive procedures? So the definition is that these are audit procedures performed to detect material misstatements at an assertion level, meaning you're going to end up auditing revenue, you're going to either audit expense, cost of sales, everything on the statement of profit and loss, as well as a statement of financial position. So you also audit like your trade payables, like trade receivables, your property, plant, and equipment, intangible assets, investment property, every line item that you can possibly find within financial statements. So you create procedures to basically address those assertions relating to those um, financial statement line items. Then, like I said, there is two types of substantive procedures, which is a test of detail, and these procedures is performed on the classes, transactions, and account balances and disclosure. So that's your ticking and bashing, or that's your actually inspecting of the sales tax invoice, for example, to the delivery note to ensure that the customer actually received the goods. um, so those are the type of tests of detail procedures you'll do. Then there's something called substantive analytical procedures. Like I said, I think it was on Friday when the student asked me what's the difference between the two. There you would analyze plausible relationships among financial and non-financial data, meaning, for example, revenue, you look at the growth month to month or the growth year on year. So for example, if you're on an audit team and your audit client tells you that we have this new product and we anticipated we're going to have a 20% increase from prior to current year. So that is then the auditor's expectation, is that there should be a 20% increase year on year for revenue. So when you, as an auditor, when you do that calculation to see what was a year on year increase, if it's 10%, then you must go find out because it's not deviating from that expected amount. So then you will put this that so then you'll end up, for example, inquiring from management as to why there is that 10% difference between what you was expected the growth should be versus what the growth is actually. So that is substantive analytical procedures, as well as any fluctuations. For example, if a company sells winter clothing, you won't expect um, winter clothing, for example, to have an increase in winter clothing in summer. You'll maybe have an expectation winter clothing sales should be higher in winter, for example. So then you'll have this trend where in summer you'll maybe see low sales, and in winter you'll see a rocket or a shoot or increase in sales. So then as an auditor, you will then go and see what is the month on month revenue for the month. And if you see that there's a high increase in summer, for example, then you can go inquire with management as to why there's this fluctuation based on your observation. Then of course, I mean, the client can tell you, oh no, because we maybe had more sales in summer because maybe we had a sale on our winter clothes just before winter started, or whatever the case might be. But then of course, you also don't take the client's word. You have to corroborate what the client says by actual physical data. They must give you then, for example, the the advertisement that there was a sale running like within summer for this period, or whatever the case might be. Because remember, as an auditor, you don't just take the client's word, but they have to provide proof for what they're saying. Okay, so when are substantive procedures formed? They can either be performed at interim date or after year end. Um, when if they do interim date, then further audit procedures will cover the remaining for that period that wasn't covered during interim. We did speak about these dates, remember, in Friday's session when we spoke about audit strategy. So in audit strategy by timing, this is where you would discuss whether you're doing an interim audit or a year-end audit. Because like I told you, if there's a deadline, if there might be a deadline issue, a tight deadline, for example. So say, for example, the year-end is or as the period financial year is January to December, right? December 2024, and they want the financials maybe the end of Jan. So as an auditor, you can go there now in, for example, October and go audit January to September. So you audit that few months, and then when you come back in January, you order then the remaining of the month. So that's an interim audit. Okay, but you see how you link in like your substantive procedures to what you basically discuss in your audit strategy. So your audit strategy would be the document where you would know, okay, this is the timing of our audit, or this is the timing when we're doing the substantive procedures and so forth. Is everyone still with me? Let me just see. Everyone with me? Any questions? Okay, everyone is with me. I see Dumisele is typing. Okay, you with me. Thank you. So now, why do we perform substantive procedure? So remember in your audit strategy and in your audit plan, so in the um, it was in the, so it's scope, timing, and direction. So in the direction, remember we said that we identified the significant risk and discussed that. In the audit plan under nature, we discuss specific substantive procedures now for what you're going to do throughout the audit. So that is because you doing substantive procedures in order to um, respond to the risk of material misstatement, or to those risky sections that you identified, even the not so risky sections, because remember we need to provide an audit opinion at the end of the day to our audit or to the or to the stakeholders that's interested in your client's financial statements, to say that this is free of material misstatement, and and we provide a reasonable assurance, meaning that we audited it. There might be some errors, but it's not material in nature. So that is why we do substantive procedures, is to get the audit evidence. Because remember, it's not just about looking at documents and signing off. So when you look at the documents, you have to record the information. So when you do test of controls and substantive procedures, you record it on something called a working paper. And you had to know what's a working paper, I think, in the first beginning lessons. So what the auditor does is, they'll have a audit file, an electronic audit file with all the sections that they audit in. So they'll have planning as a section, then they'll have all the, like the line item sections like revenue, expenses, etc., all the financial statement line items. Then they'll have finalization also folder, and then they'll have all the Excel documents. Whether if you open the document, I will tell you your client name, the auditor's name, the financial year in. It will tell you the subject, like what's the objective of this working paper. Like we all saying we're working in revenue, it will say the objective is to make sure that revenue is as, and it will state all the assertions relating to revenue. Then it will have the audit procedures as well. And with this working paper, it also tells you the reference number of the working paper. Then as an auditor, below the procedures, you will then do your findings. And from the findings, you'll do a conclusion. And then you save that working paper. If you're the audit clerk working on that working paper, and then when you save it, and then you put the date that you completed that working paper, and then someone more senior will review that working paper. So that is basically where your substantive procedures and even your planning and stuff gets documented is in working papers. Okay, I hope you understand that part. So like we said before, so there's this balancing audit equation where we discussed this for test of controls, because remember, when we do test of controls, we test the internal controls. So if the internal controls, or after we test the internal controls of the client, and we determine based on the test of control procedures we perform that the internal controls is weak, or if the scenario tell you the internal controls is weak, it means that you cannot rely on the controls. So which means the risk for your control risk, remember, what did I say? Inherent risk plus control risk is equal to risk of material misstatement. So when we speak about internal controls, when we speak about, when we speak about control risk, we're looking at the internal control. So if internal control is weak, then we say that the risk for that control is high because it's risky now for us. So as an auditor, we do not then do tests of controls, and we will do extensive substantive procedures to reduce, remember, the detection risk. And detection risk is not part of risk of material misstatement, but is part of the audit risk. Remember, audit risk is equal to ROM plus detection risk. And this is to support your audit opinion. But if the internal controls are strong, and then you can rely as an auditor on test of controls, so which means the risk for controls will be set as low, and then as an auditor, you'll perform less substantive procedures. Okay, I hope you see that relationship between that. Then always require that the auditor always design and perform substantive procedures for each material class of transaction, account balance, and disclosure, even if controls are strong. So you won't just have tests of controls on its own. So you'll either have a combination of tests of controls and substantive procedures, and remember, you determine that in your audit plan, or you'll just have substantive procedures if you have a weak test of control, but you'll never have a test of control on its own. I hope that makes sense. It just means if you can rely on a test of control, you have less substantive, meaning your sample size will be less. But if you have a weak test of control, then you don't rely on it at all, and you'll do only substantive procedures. Okay. So now, how do you formulate substantive procedures? Same like how you would formulate tests of controls, you use the how, what, and why formula. So again, the how is the action verb, the doing verb. You're going to inspect, examine, trace, recalculate, compare, analyze, inquire, reperform, and so forth. So you always start your sentence with that. The what is what documents are you inspecting, or with who are you inquiring with, or any whatever the source of the evidence is from to be used. For example, invoices, delivery note, bank statements, meeting minutes, external confirmations, or inquiring with management, or inquiring with the CFO, or whoever you're inquiring with. Then the why is the reason for this procedure. So you explicitly basically link the procedure to an assertion, depending which, if you're doing a transaction or a statement of financial position. Because remember, transactions or statement of profit and loss is accuracy, occurrence, cutoff, presentation. Um, what am I missing? Can anyone tell me? Let me see who studied.
Classification.
Classification, and there's the last one. Cutoff. I don't think I said cutoff. So that's the six. And then for statement of financial position, you always look at, remember, completeness, classification, and presentation is the same across the two. And so the only difference is you have accuracy, valuation, and allocation. You'll have existence, and you have rights and obligations. So whenever you're doing a substantive procedure, it must link to an assertion. Okay. And then you also link it to the risk being addressed. So for example, if occurrence is more risky, like if you think that this client might be overstating their revenue or have fictitious revenue, then you will focus more on assertions like occurrence, for example. So you focus on where the risk area is, because remember, not all assertions will be risky. And of course, you will still audit all the assertions though, because as an auditor, you must make sure that you satisfy that all assertions is covered, meaning that you satisfy that the revenue is complete, meaning all transactions for the year has been included in the accounting records. You that all the revenue actually did occur, that the revenue occurred in the correct period for the cutoff, that the revenue is in the correct accounting, in the correct account, and it's like, for example, it's not in the expense account or the trade payables account or whatever. That is classification. You want to make sure that revenue is presented correctly in the financial statements according to the IFRS standards. That is presentation. And yeah, I'm not sure which one I missed, but but then you get the gist of it. So it's important that you use the how, what, and why, and don't make in and make your intentions clear, basically. Because, like I said, for test of controls, it's a set of instructions that you give. Because most of the time, it's usually someone more senior creating these order procedures, or most like the big four companies, like Deloitte, KPMG, Mazars, all of them. They usually have predetermined order procedures already. So they give them that procedures to the audit team, and the audit team must follow it through. So if your procedure is not clear, like when you read it, ask yourself, can I give this to anyone, and will they be able to perform it? Is it clear enough? Is it instructional enough for someone else to perform it? So key concepts in substantive procedures, right? We touched on this on Sunday night, where I told you if revenue or expenses, like anything in the income statement, if those are overstated, then you're looking at occurrence. if you're looking at balance sheet, if balance sheets items is overstated, like trade payables, trade receivables is overstated, we're looking at existence. So that is what we remember overstated. So because remember for revenue and expenses, for example, if it's overstated, it means there's more revenue recorded as what there should be. So which means there's fictitious or fake revenue. So it means it didn't occur, hence its occurrence. And with trade payables and receivables, if it's overstated, it means that there is debtors and creditors in your financial position who is not, that doesn't exist. They're not there. They're fictitious. Hence, it is existence. So the rule around this overstatement, right? Whether it's from your transactions or your statement of financial position, you will always, the direction of testing is from your accounting records to your source document. So, for example, for sale for revenue, you'll select a sample from your sales journal in your general ledger, and then you will then ask your client, please give me the sales invoices for these select for these items I selected, and give me delivery notes. So then you'll from there you'll then inspect the invoices to the delivery notes based from the sample you selected from your sales journal. So that's the direction you test for overstatement. Then the direction you test for completeness, for understatement. That means if revenue and expense or your financial positions is less than what it's supposed to be, meaning that not all transactions or not all of your debtors is recorded, then it means it's an incomplete set. So it's understated. And to test understatement, the direction of testing would be from your source documents now, meaning you'll take, for example, it was revenue again. You will take a sales tax, you'll take a random sales tax invoice, and you will then go check to see whether that sales tax invoice is in your accounting records. Because remember, if you pick up a random sales tax invoice and it's not in your accounting records, it means it is not complete. So that's your direction for testing for completeness. So I hope that makes sense. So the same for overstatement, because if you take it from the records and they don't have the supporting doc, then it means it didn't exist. So you see why that direction is important to understand. Does that make sense? Let's see. Does that make sense, guys? That direction of testing. Okay, you understand that.
Yes, it does make sense.
Okay, cool. So then also it's important to know the reliability of audit evidence. So you consider the source, the nature of evidence, because remember, external evidence um, or it's seen as more reliable than internal evidence. Meaning, if you request a client, your audit client to provide you sales tax invoice, remember that's an internally generated document. They can they can forge that document. Whereas if you ask them for a sales tax invoice and a signed delivery note from a client, so you'd see the signed delivery note more uh as like, okay, this person signed for it, so someone did receive it, so that would be more seen as more reliable than the internal sales document on its standalone on its own. Then furthermore, how you test to see whether there is that occurrence for your revenue would be to now go see or to inspect the bank statement to see whether monies were received from your customer for that specific invoice, because that is another way, because that's even more, because remember your bank statement is an external document also, or any like third party documents like valuation reports and so forth. So any external documents or external confirmation like from the banks and stuff is seen as more reliable. Then, guys, I'm not sure if you saw this, but you'll always see sometimes in NISA in the required or tell you can discuss the general and specific audit procedures, substantive procedures. So, general procedures is applicable to all cycles. So, these are generic procedures. The only difference is you have to know what source documents you have to, or what's the main source document you need in order to perform a general procedure. But the procedure itself will be performed by in any way, like by any cycle. I'm going to explain that. So in any cycle, you will obtain a signed written representation from management across all assertions for all balances and for all transactions, right? Just be careful though. Sometimes UNISA will tell you, please provide audit, please provide or order or formulate substantive procedures for revenue and only provide us the assertion relating to accuracy. So when you now create a general procedure and say obtain a signed written representation from management, you must be specific now and say obtain a written representation from management for the assertion accuracy to determine whether the revenue is accurate in the financial statements. Make sense? So be careful. You make that the general procedure in line with what UNISA wants. If UNISA is silent in the required about what assertion you must address when you formulate your substantive procedures, then you can go crazy and say all assertions. Then you can say obtain a signed written representation from management for all the assertions relating to revenue, and you can name the assertions also, which is the 6 assertions for transactions. But why I say it's general is because the same apply for trade payables, for trade creditors, for property, plant, and equipment, and etc. But then again, you must just make sure UNISA is not asking you for specific, like UNISA could ask you provide audits or substantive procedures for property, plant, and equipment only relating to the rights of it. So then you will only then obtain a written representation from management for the rights and obligations for property, plant, and equipment. Then general procedures, you always agree totals to schedules and listings. Like I said, every cycle there is a main schedule you're going to work with. For example, for sales, you'll have a sales listing. For trade payables, you'll have a creditors age analysis. For trade debtors, you'll have a debtors age analysis. For PPE, you'll have a fixed asset register. For intangible assets, you should have an intangible asset register. For shares, there should be a shares register. Let us see. For loans, there will be a loan schedule or amortization schedule. So you see, no matter what cycle you're working with, there is a main schedule that your client must give you. Then when you get that schedule, and remember, it's just you must be specific in the general. So then you'll say, inspect, for example, the fixed asset register and cost and cross cost the fixed asset register, meaning you basically adding up all the amounts within the fixed asset register, and then you agree it to your general ledger, trial balance, and financial statement. Only the for debtors, you'll say inspect the debtors age analysis, then cost and cross cost the debtors age analysis, making sure everything does total up to that total balance. Then you'll agree that total balance to the general ledger, trial balance, and financial statements. Do you guys get me? Make sense? Give me yes? No? I
Yes.
can't see. Okay. So you get me? So I'm not going to go through about the agreed totals. Then inspect
Wait,
minutes of meetings.
can you, sorry,
Hmm?
can you repeat that?
Which one? The schedule one.
Yes, yes, yes.
So every cycle will have a main schedule that you must ask your client. Because remember, how do you know that amount or that balance in the financial statements is that amount? For example, if I tell you, if you see property, plant, and equipment in your financial position as 10 million rand, for example, how do you know what makes up that 10 million rand and where that 10 million rand come from? How do you know that is the client must provide you with a schedule. So the schedule for PPE, for property, plant, and equipment, will be your fixed asset register. Because on your fixed asset register, you have the opening balance of all your assets. Your assets will be identified separately. It will give specific descriptions. It will have opening balance. It will have depreciation. It will have additions, disposal, and closing balance. So that schedule will then have all the amounts of all your assets. Then you will cost and cross cost it, meaning you add them all up. Like you add the schedule up, like you just on Excel, you'll just like drag around all the amounts, and then you'll see whether that total balance of 10 million rand on the schedule, once you see it is adding up correctly, whether that 10 million rand does agree to the general ledger, the trial balance, and the financial statement. So it means that you are working with a complete set of schedule, and you can now know, and you will be able to also select a sample from that schedule. Make sense? Does that make sense?
Yes, 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 it makes sense.
Now the
Thank you.
same can apply with debtors. How do you, if you see a debtor balance in the financial position as 5 million rand, how do you know it's 5 million rand? You're going to request the client for a debtor's age analysis. In that debtor's age analysis, we'll have each and every debtor listed separately. So it will be debtor A, B, C, D, E, F, G, and it will have the balance for each debtor. You will then add up, make sure that all the amounts do then agree to the 5 million rand, and then you will say 5 million rand does agree to the general ledger trial balance and your financial statements. Makes sense now? Okay. So then you also usually a general procedure is you always inspect in meeting minutes for something. You either inspect in meeting minutes for like for authorization of the property, plant and equipment, or for authorization of investment property, or for authorization of maybe if it's a loan, maybe of course you must a company must pass a resolution if they want to either give a loan or receive a loan, because remember they can't just go spend how they want to. So you always like that's if there was a decision to make a big purchase, whatever. So you'll always end up inspecting meeting minutes and be specific. Say inspect meeting minutes of, or inspect the director's meeting minutes, for example, for the acquisition of the addition to the property, plant and equipment, for example, and so forth. Or inspect the director's meeting minutes for the agreement to issue additional shares, and like you, but you get that. And then also you perform an overall review of abnormal items or exceptions in your general ledger. So what you do as an auditor, you'll usually inspect the ledgers for no matter what cycle you're working in, and you look for any abnormal movements within the ledger, because sometimes people can classify things as not supposed to be, like maybe they put expense in revenue or they put a debtor in revenue and so forth. So you usually just scrutinize the general ledger to see if there's any abnormal movements or entries. Then you always would test logic of documentary evidence by recalculating. For example, that recalculating is that cost and cross cost that I spoke about, the scheduling. So you'll always see the mathematical accuracy of the schedule before you go agree to the financial statements, etc. And you'll always inspect it for presentation and disclosure compliance for IFRS. But then again, if the question says ignore presentation, then you can't tell us or give a audit or a substantive procedure around it. So just make sure you know what is asking. Then of course perform substantive analytical procedures. Can also put analytical procedures. You usually say compare month on month revenue, or compare year on year revenue, or compare year on year debtors or year on year creditors, or you'll say compare, for example, a percentage of trade debtors to revenue, because usually you expect debtors to increase in line with revenue. So stuff like that. Yeah. Everyone happy? You can just say yes, please, because I can't see.
Yes, yes, you
Yes.
are fine.
Okay. Happiness. So now where does the cards come into? So remember in Sunday session, we had that difference between when they say manual, like when they say provide manual and automated test of controls, and you'll say for automated, you say attempt to, but you need to be specific in the required, and they will say, like we saw in Sunday session, where I said that where you need to say formulate substantive procedure using the computer assisted audit techniques, cards in brackets. They will tell you use cards. Then you have to formulate using cards, and you start with use cards too. And even though you say use cards too, you will still then use the action verb afterwards. So you'll still say use cards to recalculate, use cards to, for example, compare, to scan, to extract, whatever the case might be. And you will still also relate it to the what, like what, where is it scanning? So you use card to maybe recalculate the the debtor's age analysis, for example. Or so you still make mention to the source document, and you also will still state why. You must still say why, what was the procedure that cards did. So use cards to recalculate the debtor's age analysis for the mathematical accuracy, or use cards to scan the debtor's age analysis for any credit balances, because remember debtors shouldn't have as a debit balance. It shouldn't have a credit balance. If it's a credit balance, it means it's a debtor that paid too much, and then that debtor become a creditor because it means you now your audit client now owes the client or their customer that money back. Okay, or what they can. So what you do in that case is you usually reclassify the debtor with a credit balance. You reclassify it, meaning you move it out of the debtor balance and you move it into the trade payables balance, and that would be a classification issue also. You see how I use the assertions for that. So those are the type of things, and then of course the benefits for using cards is just to be efficient and effective when testing. With cards, you can usually as an audit, um, if you physically audit, you usually do a sample, but with cards can usually do audit an entire population because it's automated. So it's the system performing the audit procedure, and then as an auditor, for example, if you say use cards to scan the debtors age analysis for any credit balance, then it will basically the audit software will then will bring up all the credit balances. And as an auditor, all you must do is now go inquire with management as to why are these debtors in the credit balance. Maybe management will give you a good reason, and then you say, okay, fine, give me the corroborating evidence for that. So you can maybe they show, oh no, this person overpaid or whatever the case might be. And then what you do as an auditor will do is you will just then go do a reclassification journal from debtor into creditors. Okay. And also the benefits for using cards is because sometimes audit clients, depending how big your audit client is, like a small client won't have necessarily huge data, but a bigger client, like for example, like Eskom or okay, but that's more government, but like Pick and Pay or Clicks, I mean, imagine how much data they have. Like Clicks have over 500 stores nationwide. So there, for example, an auditor would want to use cards to assist them with the audit. Okay. Then, like I said already, here's examples. So use cards to scan the sales journal for unusual transaction outside the normal trading range trading range and print an exception report for investigation. Use cards to recalculate the depreciation expense for the fixed asset based on the company's policy and compare to the general ledger balance, investigating significant differences. Use cards to select a sample of invoices above a certain monetary threshold and extract their details from manual. You see, so it's very specific. There's the how, what, and why still within using cards. It's just the computer is doing it for you instead of you. And you see, it's nice because the computer software can recalculate all the depreciation expenses. Whereas as an auditor, if you must recalculate it yourself, you will just do a sample. So you will then select a sample from the fixed asset register, and then you will recalculate based on that sample. Because as an auditor, you're not by the means to work as fast as a computer, hence we use cards. Okay. So now, is everyone still awake?
Yes, we're still up.
The substandard procedure will tell you whether for inventory investment. Who's asking this? Is it Matipi? I'm not sure what you mean by the substandard procedure will tell you whether for inventory investment disposal PPE. What are you asking? Because you would use substandard procedures for all your cycles, for inventory, investment, disposal, PP, and all those cycles, but we're going to go through now each and every cycle. Palesa, I see your hand is up.
Oh, yes. It's regarding one of the procedures on the last slide, the first one that says use cards to scan the cells. So do I need to use the term scan, or can I say inspect or scrutinize?
Don't say inspect, because remember, inspect is more of a humanized type of thing.
Alrighty.
For computers, you can rather say scan or scrutinize. Not yeah, scrutinize is fine, but don't say inspect.
Okay, so scan is
But
the
rather
best
stick
term
with
to
yeah,
use.
you rather stick with scan, because remember a computer will scan the document.
Alrighty.
Makes
Okay, thank
sense.
makes sense. Thank you.
Yeah, I think the only one you can really use is recalculate. The like if you're thinking of the verbs. But the others would be scan, extract, or compare, stuff like
Because
that.
I see here they also used select a sample, which a human can also select a sample.
Yes, a human
Oh,
can also select a sample. It depends
okay.
how. Sometimes an auditor can want a cards to do the entire population, but sometimes they will also maybe let the cards only do a sample. Makes
Okay, cool.
sense.
Makes sense.
Okay.
Thank you. Bye.
Okay. So when we use cards, we cannot select a sample. It depends. It depends on the auditor and what the auditor want the computer to do. Because sometimes even if a computer can scan an entire population, it depends what functionality you want the cards to do. Because sometimes a scanning of something may be more rigorous, will maybe take days. So then in that case, an auditor will then rather say use cards to do a sample. So rather go through examples of cards in your tutorial letter so you can see when they you say you use sample or if they don't say use sample. But usually a card can do an entire population. Okay. I see there's another typing. Okay, noted. So we can continue. So now this part, right? Why is that thing not hiding? Okay, now so for now we're gonna go into the cycles, right? So it's always good to visualize the cycle or to visualize your scenario. So if you read in the scenario, like see where we are in this process. Are we in the customer order or like are we in the beginning process where the customer's busy ordering? Are we by the picking of the goods? Are we by the dispatching of the goods? Did the driver already deliver it and return the necessary documents? Is it in the accounting department now where they must now issue the invoice? Once they issue the invoice to the customer, then of course they must record the sales within the accounting or within the system. So it's nice to know where are we in this process. And like I said, you must know how many documents. Like for example, I think you have 4 internal sales orders because the one gets retained during the ordering stage. The one goes to the picking department. Then they create a picking slip where they'll pick the goods. Then I think it's 2 if I'm not mistaken. And then when it goes, then it gets transferred from the picking to the dispatch area. Then you will get the delivery note that must be created. I think you have 4 delivery notes because the 2 goes with the driver. The driver drives. He lets the customer sign both. The customer would keep the one. Then the driver will return with the one because that one that was signed will go to the accounting department. And then one of the purchase orders also go to the accounting department, who's an accounting department check the purchase order that the customer had against the delivery note that the customer actually received. Because on the delivery note, it will show what goods the customer actually received. Because remember, your purchase order, there could have been things out of stock when they eventually delivered it. So then the accounting department then needs to go process or issue the invoice based on what the customer received. Hence, it will be based on the delivery note what the customer signed for. And then once the invoice is issued, of course you will process the invoice in the financial statements, meaning you'll see it as a revenue. You'll credit revenue and you'll either debit trade receivables or debit cash and cash equivalent. Um, the other thing is if you in the purchasing order in the beginning cycle or in the beginning of the cycle, you also have to determine if it's a cash paying customer, if it's an existing customer or a new customer that needs debt. Because if it's a new customer that needs debt, then there's an additional part to the purchase orders where you have to now first determine whether the customer is credit worthy. Then it goes to the credit department first to do that whole analysis for credit worthiness. So there you'll have also documents. Does that make sense? So now the key is, so like I said, so you'll have revenue. Then because when you capture the sale, you'll credit revenue and you'll either debit trade receivables or you'll debit cash and cash equivalent. Remember, guys, the other leg to trade receivables is allowance for credit losses and bad debts. I think we did discuss this on Friday, if I'm not mistaken, or was it on Sunday? I can't remember. But whenever you have trade receivables, you must know that there is a big chance that your debtor might not pay you, or the debtor might not pay your audit client. So if debtors might not pay your audit client, then what the audit client would do is they create this estimate, especially if they don't know who's the debtor that's going to default. So what they'll do is they'll say, okay, based on all our debtors, say the debtors balance for all the debtors is 20 million rand. Then they'll say, based on all the debtors, we expect a 5% that we need to have as an allowance for credit losses. Then they'll take 20 million times about 5%, and they'll see that as an allowance for credit losses. It's also in the statement of financial position, but that will reduce the debtors balance in essence on the financial statements. So you see, that's an estimate. Whereas when you look at bad debts is when the client, your audit client now knows that customer X is going to default. Meaning that we must, so from the 20 million balance, customer X is maybe only 500,000. Then, then as the audit client, your audit client will say, okay, customer X, he's not going to give us the 500,000 because apparently maybe he's under business rescue, or you don't have the money, it's under liquidation or whatever, then your audit client will then go write off that full 500,000 for customer X. You see the difference. So bad debts is when you actually know that that customer, and remember, if you're auditing bad debts, then your client must give you supporting docs of that specific debtor that's defaulting, because the debtor would have emailed the audit client and say, I'm unable to pay this 500,000, please write it off, or I'm in business rescue, whatever the case might be. Whereas for allowance, what the auditor will do is it's based on an assumption. It's an estimate. So as an auditor, you will go and determine whether that estimate is reasonable, and so forth. Okay, like that 5% is reasonable. So we touched a bit now on that. But for revenue, like you know, it's a transaction. So these are the assertions relating to transactions. Where there's always an issue or a risk is, we always have this presumption that companies might overstate or want fictitious sales. And remember, the scenario must prelude you that there might be a possibility of overstatement. So whenever you see maybe executive directors is going to get a bonus based on revenue, then of course they would rather want to overstate revenue than understate. So then there'll be a risk in there that there'll be fictitious sales or fake sales. Okay. So remember, this is now where it comes from direction. Because what we say, what is the direction? We said the direction would be from the source from the accounting records to the source. So you select it from the sales journal and you trace it to a delivery note and an invoice. That's to make sure that whatever's recorded in your financial records is the supporting documents for it. Then there could also possibly be a completeness issue, which is an understatement issue. Hence I said, remember, you can't have both. Like you can't, like if the scenario is preluding you or telling you there's a possibility for overstatement, then you can't say overstatement and understatement. The only time you say overstatement and understatement is if it can go either way, if the scenario is preluding you in that manner. But if it's an understatement of sales, it means the risk is unrecorded sales. And like we said before, the direction would be from the source now to the journal. So you'll basically go take a random sales invoice or a random delivery note, and you'll trace it to the sales journal. Then, of course, accuracy. Accuracy is always a risk for incomplete pricing calculations. So there you'll recalculate invoice totals, compare prices to authorized price lists, and so forth. Even though we never discuss cutoff, but cutoff can be an issue. And remember, guys, when you discuss cutoff, you must state there. Inspect, for example, inspect the delivery note to ensure that it's in the correct period, or in the financial year that we are auditing, and then say cutoff. Whenever you discuss cutoff, you must always state it in your procedure. It must be in the correct period. Or you say inspect a sample of delivery notes before year, after year, and to ensure that the the deliveries was made before year end and it was recorded before year end. Because sometimes what they do is they only deliver it after year end, which means it will be shouldn't be in year end and so forth. Or they deliver after year end and they put it in before year end or vice versa. Or it's for something for after year end, and yeah, you get what I'm trying to say. I hope. And then of course classification, like I said, is if revenue is when they put revenue maybe in debtors or they maybe put revenue in as an asset, for example, and not as in the as an income in the income statement. Or they put revenue in expenses and not in the actual revenue account. So that will be procedures around that. And of course, presentation is if it's the incorrect, if it's not presented according to IFRS. Okay. Then trade receivables is account balance. So that would be all your existence, right, and applications, completeness, accuracy, evaluation, allocation, classification, and presentation. Existence, like we said, if it's an overstatement of debtors, that will be existence. So fictitious debtors or fake debtors. Then there you'd usually do data circulation. So that's external confirmation. So usually what we do as an auditor, we'll select a sample of material debtors. Then we will write a letter to the debtor and we'll say, we're the auditors of XYZ and we've noted that your balance as at December 2024 was this amount. Do you agree or disagree? And then they will send you back, agree, they'll sign it. So you see, so you get an external confirmation. But remember, you get positive confirmation and negative. You must just go see what's the difference. I think the one is where if the debtor don't respond to you, you just assume the balance is correct. And the other one, I think they must respond to you and sign it. I'm not sure. You can just go check what's the difference. Then you have accuracy evaluation and allocation, and there's a risk that the amount is incorrect. So there you'd usually like whenever, for example, you maybe inspect the data statement, because remember your audit client will provide data statement to your data, and also that confirmation letter that you send to your data will also help you with the accuracy part as well, because they agree in the balance at year end. You can also recalculate or do that cost and cross cost, but that's more general procedure. So you see, because all these procedures here are more specific to revenue. Okay. Then we spoke about the allowance for credit losses. So there, like I said, you'll, for example, for allowance for credit losses, you will inquire with management with regards to the assumptions used for allowance for credit losses. So when you inquire with management, then they will tell you, no, we use 5% or we use 10%. Then the next step is now to determine the reasonability of that 5 and 10% that they use to calculate the allowance for credit losses. And then you end up recalculating it. So you'll recalculate that 20 million example I used earlier times by the 5% to ensure that the balance is accurate. For bad debts, you basically inspect again. You can recalculate bad debts. You can inquire and all those things. You can obtain um, emails maybe from the debtor to say they won't be able to pay their debt, or you could even obtain, for example, if they took the debtor to court, you can obtain the court evidence or the court order and stuff, and all the court proceedings basically is what you're going to obtain to determine this was a bad debt. Then cash receipts, guys. So now you'll see here, I have it as a transaction and a balance. Reason being, cash receipts is a cash and cash equivalent. It's in your balance sheet. It's easy in your financial position, right? But that's for the balance. Because remember, it's a running balance. So at the end, if it shows that there is 3 million in the bank account, you'll inspect the bank statement as of year end and agree the bank statement for that 3 million. So that would be a statement of financial position procedure. And that would be the ones identified here by account, by trade receivables, those assertions, right? But transactions within the movements for the year is seen, like for example, receipts from customers is seen as a transaction. Does that make sense? So receipts from customers would be seen as a transaction, and hence that will be transactions assertions or statement of profit and loss. Does that make sense, guys? You can just say yes or no.
Yes, it does.
Okay, perfect. Then, okay, so you can just go through that. So completeness is again unrecorded cash. accuracies about the amounts, etc. Then this analytical procedures for revenue and receipts. You see, so you compare current year sales with prior year sales, or with budgeted sales, or with industry data or industry norm. You'll calculate gross profit percentage and compare to prior periods or industry norms. You'll calculate debtors days, for example, and compare it to credit, and always investigate significant fluctuations or anomalies. So you see, so it depends what you are. So if you discuss in revenue, you can only discuss analytical procedures relating to revenue. This one over here, debtors days relate to trade debtors. So when you discuss in, then you must discuss trade debtors analysis and so forth. Then we really kind of touched on this. So use cost to extract the sample of invoices based on criteria, high value. So you see here, they'll use a sample, because remember, sales invoices will be a lot for the year, especially if it's a big company. So there a cost can't go use or to the entire population. So there you can say use cost to extract a sample of sales tax invoices. And then basically it depends what the auditor wants. So maybe he just wants all the high value sales tax invoices, or maybe just 1 year in sales tax invoices to maybe inspect for cut-off issues. Because if he select a sample of year in invoices, then he will request the client for the delivery note, because then the delivery note will show you whether that invoice, that sales invoice, was delivered at year end. Because remember, a sales invoice can be for example, the 31st of December. But if they delivered it only on the 1st of January the following financial year, then they shouldn't have recognized that sales in December, but in the new year. So that's when you want to test for cutoff. And then, of course, you can use cards to scan sales for unusual trends, for large credit notes, and so forth. And you can use to recalculate revenue and whatever the case might be, and based it on delivery notes. Oh, the other thing we never spoke about is credit notes. So credit notes must also fall in here, but credit notes is only when your audit client do issue a credit note, because maybe their customer is not happy with the goods, they're returning the goods, or they weren't happy with the service, and now we're going to issue the client, your audit client is going to issue them a credit note. So you also would test credit notes. Credit notes would be a test on its own. The substantive procedure must tell you, formulate substantive procedures on the credit notes. Or sometimes they don't tell you that. Sometimes UNISA can tell you, formulate the substantive procedures for revenue per the information line. But then when you read the scenario, they'll tell you in the scenario, this is the revenue amount, and there was a credit note of this amount. As soon as you see the scenarios, they have a credit note, and then you must know, you must also then, for example, provide the credit notes substantive procedures. Okay. Happiness. We're going to go to acquisition for payment cycle.
Can we go back to cash receipts? I know I said yes, I understand, but
Okay.
I think I have questions because I see it says transactions slash balance. So it can be tested as a transaction and it can be tested as a balance.
Yes, so when we test it as a balance, when we test cash and cash equivalent as a balance, we're testing that from a balance point of view, meaning in a financial position under cash and cash equivalent, say for example, it says bank, standard bank, maybe your audit client have a standard bank account, and that balance in the financial position says it's 3 million rand, right?
Mm-hmm.
Where do you think you'll find that where will you find the document for that 3 million rand? You will inspect the bank statement as of December year end, isn't it?
Yes.
And that bank statement will show the 3 million. You see, so that's the balance. So that would be the that will take so for example, that would be accuracy, valuation, and allocation. Do you understand?
Okay.
But
Alrighty.
transactions is the movement within the bank. Meaning if you receive money from if your audit client receive money from the customer, that's
Yeah.
seen as a transaction.
Okay.
Makes
Yes.
sense?
A movement within revenue. Is that
Yeah.
correct? Yes.
Yes. Because
Alrighty.
remember, you would credit revenue and
Yeah.
and debit bank. That's if it's a cash paying customer.
Okay, so can you also touch on the credit note? I'm just trying to wrap my mind around
Okay.
how would I
So
test it?
okay. So now, for example, the client have revenue in their accounting, right? Say, for example, you were the customer and you bought maybe socks for 500 Rand, right? So that revenue was already recorded as 500 Rand. But now you saw that the socks is damaged, there's a hole in the socks, and you're going to return it now to the to the shop. Then that, so I'm now the auditor, and
Yes.
basically they would have issued you, their customer, the shop, Pick and Pay maybe would have issued you the a credit note of 500 Rand. So
Yes.
then, as an auditor, because remember, there was a revenue for that socks initially. So, which means I now have to go reverse. Like, so I will have to now reverse that entry. Not reverse it, but I will issue a credit. That credit note will then take that entry out. Does that make sense?
Yeah, to
So
decrease your
you'll debit,
revenue.
yes, you'll debit that revenue amount. Hence, as a, that's why you would audit credit notes on its own, because you would then, for example, inspect a sample of credit notes. Because
Okay.
remember, you must ensure that the credit note did occur. It is accurate. It is complete. So what we'll do is we usually ask the client for a sales listing, right? In the sales listing, we'll have revenue and credit notes for the year. Then what we do is we'll sample the credit notes on its own. So for example, if there's maybe 1,000 credit notes, then we'll sample it and we'll maybe select maybe 150 credit notes, and we'll select random 150 credit notes, and the client must give you documents for that 150 credit notes. Because
Okay.
remember, if you return the socks, remember what
Yes.
does Pick and Pay do? Pick and Pay then will give you a till slip, and they'll tell you please sign and put your cell phone number down.
Yes.
Because that is so. If as an auditor, I will then go inspect that till slip to see your signature and your cell number, because that's confirmation that you did return the goods. What some
Okay.
what some audit clients do is they do actually issue a return slip, or they issue like a return document where a customer will also sign. Make sense?
Yes, can I just ask something as well? Like in terms of credit notes, can I say, can I have a procedure that goes something like inspect the bank statements to check if the refund or the money was refunded to a client as per the credit note?
You can say that, yes.
Okay,
You can say,
alrighty.
but just make sure, because sometimes what they'll do is just make sure in the scenario they might give you the date that the payment was
Mm,
returned, and you make use of that. And don't say check, rather say, I don't because as jargon, like I don't like check and look. So
mm.
say like inspect
Inspect,
inspect
yes.
the banks, or first maybe inquire by your client to find out when did you return the money from to the customer. Then once you know the date, you're going to say inspect that specific bank statement, dated whatever, to ensure that the funds was returned from the client or from that person to the customer. Make sense?
Yes, it does. Thank you so much.
It's a pleasure. Can I move on?
Yes, you may.
Okay. So for acquisition and payments now, so this is the reverse of your revenue and receipt cycle. Because remember, revenue and receipt cycle is your audit client is issuing goods or giving goods to receive money. Here, your client is now um, receiving goods, inventory or purchases, and they are
Paying.
paying for the goods to the supplier. So here again, you must think, where are you in the process? Because first part would be is having the need for the purchase. Then once you know you need something, you would have a purchase order. The purchase order must, of course, be authorized by someone. Remember, someone who create the order can't just authorize it. Because remember, there must be segregation of duties. Once it's ordered, it also needs to go to, usually they'll say 3 valid quotes from suppliers. Then you select the best quote, then you send it to the supplier. Then remember, now the supplier delivers it to the ordered client. So when when it gets received by the supplier, it goes to the warehouse, to a designated warehouse. Remember, you can't receive goods in an admin department. You can't receive goods in any other like any other area but a designated warehouse. At the designated warehouse, there must at least be, I think, 2 warehouse clerks that will go check. Okay, not okay. In order terms, will inspect, but they would check the actual physical goods received from the supplier to the purchase order and the supply delivery note. Reason being, remember your warehouse clerk do not know what was purchased because the purchase is done by a different department because that's segregation of duties as well. Hence, the purchase order goes to the warehouse as well. So when the warehouse do receive the goods from the supplier, they physically inspect the goods. Why physically inspect the goods? They need to inspect the goods for any damages or all that stuff. And then they will compare the purchase order to the delivery note from the supplier. And then once they are happy, what do they create? They create a goods receive note. In the goods received note, they basically state these are what we receive, the quantities, amounts, etc. And the one goods received note goes back to the supplier and the one gets retained. Then that gets sent to the accounts department. The accounts department, of course, have to wait for the supplier invoice. When they receive the supplier invoice, what do the accounts department have to do now? They have to basically check the supplier invoice to the goods received note, because remember that's the note that was internally generated to say we did receive the goods, and to the purchase order to make sure that was the goods ordered initially by the order department before they go and raise it in the accounting records as a purchase. So they would debit purchase and credit trade payables if it's a credit, if it's a supply that the client has on credit, or they would credit cash and cash equivalent, because remember it is if it's cash. Makes sense? Remember guys, if your accounts department have a discrepancy between the supplier invoice and the goods received note, remember the person can't just say, let's just take it according to the supplier invoice. Then they will literally have to call the supplier and say, look here, there's this difference, and they have to resolve the difference. And of course, either the supplier made a mistake and they will recorrect it, or maybe the mistake was on the side of the client that you ordered in. Okay, does that make sense? So like I said, so purchases is a transaction. So there you have all your transactions assertions. I don't have it again stated, but if you want to look at the assertions, you can always go back to the revenue slide. So then again, the same kind of thing happens. So as completeness is if it's unrecorded purchase, meaning they didn't record all the purchases for the year. So it's an understatement of expenses or liabilities. Because remember, if they didn't record all the purchases, they didn't. So that they didn't. The debit leg don't have. So which means the credit leg will also be short. Okay. Or if it's not liabilities, the credit leg could also be then your cash and cash equivalent. So which means your balance will also be is it understated? Or actually your cash and your balance would be overstated, because remember you have now still the money is still reflecting in your bank balance, because it's supposed to reduce your bank balance. Does that make sense? And you see, okay.
Yes, it does.
Yeah, so you see that's how you think about it. So in this case, so if it's completeness, again, you must look at the direction of testing. Remember what was the direction we said? We said it's from the source document now to the actual um, um, journal or the
General
actual
ledger.
records. Yeah. Then
Yes.
occurrence again is if there's fictitious purchase. Again, when we overstate purchases. So there's fake purchases, there's purchases not supposed to be there. And remember, if there's overstatement of purchases, it means that there would be an overstatement of liabilities, which will be existence. And it means that then will be the opposite for your cash payments. But you can read that yourself. Then of course trade payables is account balance assertions. So it's complete. That's the reason why we have obligations only here. Because remember, I never explained this to you. But the rights usually relates to assets. Because when we speak about the rights, we are saying that the company has the right to the asset, meaning the debt, the company has the right to the debtor's money that is owed to the company. So when you inspect or when you do procedures for rights, you'll say inspect, for example, the debtor's statement to ensure that the statement is in the name of the customer and your audit client. Because sometimes what they do is, especially if it's group company, sometimes one company will go process the trade debtors of one of a different company within the group of companies. Does that make sense? or the expense is not in the name of the company. So that's how you do the or like for the debtors, that's how you do rights, or if it's a loan agreement, remember, okay, but that's obligation. If it's a credit, let me see what other. If it's property, plant, and equipment, for example, and assets like intangible assets or investment property, how do you know the company has a right to that? Meaning it's their property. You'd inspect the invest like the lease agreement, for example, or you inspect the actual investment property agreement, because in the agreement itself it'll have the purchaser and the seller name, and both parties must sign the agreement. That's how you know it's in the name. So for credit, for trade payables and loans that the company makes, that means, are they obligated to pay a supplier or to pay for that loan? So that's what we mean by obligation. So meaning that trade creditor that they owe, that supplier they owe, it is in their name. Does that make sense? So you can always look for at obligations by inspecting, for example, the creditor's statement, or the agreement between the supplier and your client and so forth. You can also do an external confirmation with a creditor, meaning you would go email now, like you email the debtor, you can go email the creditor, but this is not really done in auditing, to be honest. You because the thing is, remember, if you owe your supplier, so like we'd be more concerned with the assets, but yeah, but you can still do an external confirmation for your creditor as well. Then the same, like we discussed for cash receipts, yeah, cash payments work the same way. So the balance itself is the balance part, and the transaction would be now the payments to supply. So the movement for the year, the payment to supplier. Does that make sense, Palisa? So it's kind of the inverse of your other side.
Yes, I do get it.
Okay. And then here again, by the analytical review procedures, you have current year versus prior year, budgets, analyze the key expenses to utilities. Here you can also say, because most of the time, especially for expenses, we'll always say we assume it will increase by inflation, because most companies would increase their expenses by inflation. Rent expense, though, for example, that would be increased according to the escalation rate in the agreement, lease agreement, for example. So if the lease agreement says there's an escalation rate of 5% year on year, so your rent expense should be 5% year on year. So if it's out of that, you would go confirm why is there a fluctuation and so forth. Then of course, use cards. You can go see, you can use cards to scan payments for duplicate payments, for large payments. You can use cards to determine whether purchases made was to the approved supplier list. So cards can even pick up if you use if your client use an ad hoc or some supplier that's not on the approved list. You can use cards to sample supplier invoices. Now, guys, please remember this is not thorough procedures. This was just to have it on the slide. Because remember, yeah, I say invoice, and by revenue I say invoice. So by revenue you should say sales invoices, and by purchase and payments you should say supplier invoices. Okay, so you can see that you know the difference. Next is inventory and production cycle. So this cycle, like I said on Sunday, is very similar to purchases and payment cycle. It's just this one is focused on manufacturing. So instead of your client ordering now a good and selling that good immediately to your customer, your client now is purchasing raw materials, and that raw materials is going to go into production. The production is going to make a finished good, and the finished good is going to go to your client. So there again, you must know every part within that cycle. So you must know where you're at, because if you purchase the raw material, of course, you'll still have the purchase order and must be signed by, authorized by someone. Once you receive the goods, the raw materials will then also be checked in, like we said before, by clerks, and they will still do the same observation by comparing it to the supplier delivery note, to the purchase order. Then they'll also create a goods received note. But the only difference is now the raw materials get stored, and it only then when they need the raw material in production, then they will transfer the raw material to the production. Then you have the raw material transfer note. And within the production itself, you have job card and all that stuff. So you have documents in there. And then from there, it gets transferred from production to finished goods, and you have the through the finished good note and so forth. So here again, inventory is an account balance. Again, if it's overstatement of inventory, it will be existence. It means that there is inventory that do not exist. Usually there you can attend inventory counts or do physical stock takes and so forth. Completeness is an understatement of inventory. So it means that not all inventory has been recorded. And like we said before, you will take completeness from floor to the sheets. So you see, so it trace inventory count sheets to the records basically. And then of course, there's accuracy evaluation, rights and obligation, and so forth. Okay, so all the other stuff would also be, for example, you have trade payables here in the cycle also, because remember, your supplier can still be a, you can still, for example, your order client can still purchase the raw materials on credit. So you'll still have a trade debtor, or you'll still have cash and cash equivalent. Makes sense? So that's why I don't have that on the slide, but you must still think of what's the other leg, okay? Of you, because you always, whenever you think of assertions, you always think of like what's the accounting entry. So you'll debit inventory, you'll credit cash and cash equivalent, or you'll credit trade debt, trade creditor, sorry. Then here, analytical procedures for inventory is usually inventory turnover ratios with prior years. You look at industry benchmark. You look at gross profit margins as well, and fluctuations between inventory balances and categories and so forth. For example, if a client maybe have like different inventory that they manufacture, maybe they have 3 different products that they manufacture, but maybe one of their products is the best seller. Or so if you see their best inventory product is like, abnormal, you'll question it and so forth. And then use costs to perform test recounts of inventory, use costs to recalculate inventory costing. When it comes to accuracy evaluation and allocation, there you also look at first in, first out method. You look at net realizable value per IAS 2. You look at the standard costing method. So there you always recalculate according to whatever scenario states. What do they use? If they use first in, first out, weighted average, you'll recalculate it. But or you can use cost to recalculate those costing methods. You can use cost to scan the inventory master file for any negative quantities or unusual descriptions or descriptions that might not belong in the inventory. Maybe, for example, they manufacture dolls, but somehow in the inventory list they have pens. So cost will be able to pick that up. You can use cost to identify slow moving or obsolete stock. And remember with stock take, you also would look at those stock like damaged stock or slow moving stock, because remember that stock must be separate from the normal stock. Payroll and personnel system. So this system or this cycle is about, what's the time? We over. Can we still continue, guys? Or do you want me to continue tomorrow? You want me to continue? Is everyone there?
Yes, you can continue. I don't know
Oh,
what the others are saying, but yeah.
okay. So, substantive procedure for payroll and personnel, that is your HR. That is now salaries and wages, right? So, here again, you visualize the cycle. Where does the cycle start? Of course, the cycle starts with the need for an employee. Then they'll put the advert up, and then they will interview people. Once they interview and you have a successful candidate, they'll sign an offer letter. From the offer letter, they'll sign a contract, employee contract. From the employee contract, once it's signed by the necessary relevant parties, it will go to the payroll department, where the payroll department will now add the new employee to the payroll master file. And then when the employee starts, of course, then there's the payroll itself. So there will be the net pay, the deductions. So it will be the salary, the bonus, overtime. It will be deductions to SARS, for which is pay to earn, UIF, SDL. It can be medical aid deductions. It can be provident fund and provident, or not provident, as now retirement annuity fund deductions. All those deductions would go to third parties. Like SARS will be kept by the employer and get paid over to SARS. The medical aid will be paid over to Discovery or whichever medical aid. And the retirement annuity funds will go to Sanlam or Old Mutual, whatever the case might be. So every part you would have to audit basically. And then also don't forget your terminated employees. So either they got fired or they resigned. So you get all the procedures around that too. So for example, if Palesa, if you resign in March and I go inspect the payroll for this financial, or say for the financial year ending June, then from April I mustn't see Palesa on the payroll system. There should be zero by your name. So those are the type of things we would inspect to make sure that if a terminated employee left a specific month, that there is no continuous still salaries and deductions going off for a person that's not there, because it means then that employee is fictitious. Other thing is, and also as an auditor, we'll inspect the termination or the resignation letter. If it was being fired, we'll inspect for example, what you call that disciplinary hearing, whatever reason they were fired. If it's a new employee, we'll inspect employee contracts and so. As an auditor, we can also physically inspect employees, because how do we know an employee physically exists? What we do as auditors, we usually would take an employee contract and then we will take an ID and we'll walk up to the person and say, can you please, of course the ID have a photo, and we'll say, can you please confirm your ID number? Then you know, okay, because I mean, what person won't know the ID number? So that's how we physically verify that the actual employee exists. But then again, so when it comes to the payroll, every month, depending if it's salary, it's monthly. If it's wages, it can be weekly, it can be bi-weekly, it can be every fortnight, whatever the case might be. Salaries can be paid via EFT, via EFT or via cash. The other thing is salaries also need to be recorded at the end of the day. So you'll record the net salary that they actually got, okay, that was given to the employee. You'll record the amounts that you paid over to SARS per employee, and all that stuff. And remember, you must know the documents in there also. So you'll have pay slips, you'll have employee contracts, you have bank statements. Because remember, when you pay your employee, you can inspect the bank statement to see that it went off. For the SARS payments and the Discovery payments and that, you'll inspect the bank statements that the employee actually paid it over. And remember, what other documents will there be? Before your before the client sends or pays over SDL or pays it into SARS, they have to put it on an EMP, a SARS document called an EMP 501, I think, or 201. It's an EMP 201. So on there, every month, a company would submit this to SARS, where it will give a total amount for pay as you earn, UIF, STL for all the employees, and we have a total amount that will be paid over. So as an auditor, you will inspect the SARS documents to ensure that does agree to the amount paid in the bank statement over to SARS, and so forth. So you must know which documents you're working in. So there you have, so payroll itself is a transaction, because you know it's a salary and wages expense in the statement of profit and loss. So there you look at occurrence, so they can be fictitious employees, um, and so forth. And then you look at accuracy, so there usually you'll recalculate wage rates if it's wages, or what you can do is you can recalculate, for example, if it's a salary worker, say the salary worker gets 12,000 a month, then you say 12,000 times by 12, for example, should be the annual, and so forth. So you can recalculate salaries, you can recalculate deductions, because there's rules behind pay as you earn. Like depending on which individual tax bracket you are, you can recalculate the pay as you earn. Sorry, you can recalculate the SDL, and so forth. And then of course, completeness is if it's unrecorded payroll expenses or liabilities, meaning they didn't record all the payroll. When do you have a liability for payroll? When do you think you'll have accounts balance? Is usually for at year end. Or what happens is, I'm not sure if you know, but as an employee, you usually accumulate leave, right? So at year end, they should, for example, if I have 10 days leave at the financial year end as an employee, that should be seen as a provision for leave. And that's in the statement of financial position. So this leave pay, so at the end of the year, your audit client would have a provision for leave pay, and you will go make sure that provision for leave pay is is accuracy, evaluation, and allocation. You'll check that. You'll check completeness. You'll check for the existence and all those things, because so you'll see, like, what you'll do is you'll maybe ask, you'll request the pay slips for a sample of employees at the financial year end, because on the pay slips itself it will show what is the balance of the leave um, for that particular employee. Then you times it by the employee's rate, and then you can determine what was the. So basically what the client must give you here is they must also give you a leave provision pay schedule, because on the leave provision schedule it will tell you all the employees, their balance as at year end, what was their rate, and what is the balance, because remember you must get the total provision, because if you look at the financial position you only see the total. So hence you need a schedule to see the individual so that you can perform a recalculation on the individual and so forth. The reason why pay as you earn UIP and STL is an account balance usually at year end. Throughout the year, it goes as a balance, but it gets reversed again, because what happens is at the end of the month, I think for SARS, they must only pay it over like the 7th of the new month. So you see, so for example, if your financial year end is December, so at the end of December, it will still be seen as a liability in the books of the client until they pay it over in January, because SARS only wants that by the 7th of Jan. Makes sense. But throughout the financial year, it will go in as a liability for say, for example, January, but by February it will be expensed already. So it will already be reversed. So the only amount that will be a liability at the end would usually be the amount at year end. Does that make sense?
Yes, it makes sense.
Okay. So then those, of course, so all the balance sheet assertions that goes there. Then, of course, you have the comparisons now. So you say total expense via prior year, budget, number of employees, average salary per department, compare actual deductions paid as you earn to expected amounts based on gross pay. Or what you can also do here is, for example, you can compare salaries year on year, or like if you see there's an increase of 20%, maybe they gave increases of 20%, which is unlikely, because most of the time they only give 5% increase, but say they give 5% increase. So you expect salaries to increase by 5%, but if you see that salaries increase by 10%, you have to inquire by management and find out why. Maybe besides increase, there was also bonuses given, which will increase that percentage a bit more, or maybe there was overtime included. Okay. So you use card to scan payroll master file for duplicate employees, for missing employee IDs, or employees with no deductions. You can use cards to scan for even terminated employees and whether the terminated employees was paid after being terminated, because of course, then that's an error. You're going to use cards to recalculate gross pay, deductions, net pay, and all those things. You can use cards to compare hourly rates or salaries to authorized rates to industry benchmarks, or you can use cards to identify employees with excessive overtime, because sometimes in the scenario they'll tell you there's only this maximum of overtime. Like I think yes, on Sunday session we said there's only 10 hours of maximum overtime that can be worked. So then you can use cards to scan um, the payroll master file for any excessive overtime that exceeds 10 hours. Okay. Last but not least, we have the finance and investment cycle. So here it shares your long-term loans, your property, plant, and equipment, investment. I'm not going to go through this because this one don't really have cycles like I mean or stages like your previous. Because here's just like if you have share capital. So just I'm going to go through the next slide that goes through this so you can read through this yourself. I think you should know. But share capital can be seen as account balance and a transaction, because if it's a new transaction or if it's a newly issued shares within the financial year, it's seen as a transaction. But I'm going to go through to show you where in your books, in your auditing notes for South African students, you can find that. Long-term loans and leases is, of course, account balances, but the repayments of long-term loans within the financial year is seen as a transaction, but we're going to go through that. Property, plant, and equipment is a gain account balance, but can also be transaction. Remember, the balance itself is a balance. So remember, in the fixed asset register, you have opening balance, depreciation, additions, disposal, and closing balance. So additions for the year and disposals for the year and depreciations are transactions. So there you'll use transactions. Then investments, account balance, and transactions as well. Transactions is also around movement of investments in that current year. Then of course the statement of the analytical procedures is to compare, for example, the interest expense to average loan balances and the market rates, or analyze depreciation rates against useful lives and so forth, looking at budgets or capital budgets for PPE. You can use cost to recalculate depreciation. You can use cost for high value assets and for market value of investments and so forth. So now this is the exceptions, right? So share capital is occurrence accuracy, so it can be transactions. And please go look at chapter 14, page 12 to 13. There they give you all the procedures there is for share capitals. But please make it relevant to your scenario. Don't just dump it, okay? Then debentures is also accuracy, occurrence, accuracy, completeness, classification. So again, refer to 13 to 15. So it's the next section below share capital. Then long-term loans is existence, rights, and obligations. So this is the statement of financial position, right? That's 15 to 16. But if you look at 34 to 35, if you see new loans and repayments of loans, this is seen as a transaction and not now as a financial position now, because it's seen as a transaction. So please go look at that page numbers. Then leases, of course, is also a statement of financial position. You can look at chapters 14, page 16 and 19. And then, of course, the depreciation of your lease for a right of use asset will, of course, be a statement of profit and loss. Because depreciation is in your statement of profit and loss. Then provision, contingent liabilities, and contingent assets is a statement of financial position. There's procedures around that on page 1923. Then PPE, like I said, is statement of financial position on page 23 to 30. But if you look at it, you'll see that additions, disposals in the current year is seen as a transaction. So if a scenario tell you there's an addition and a disposal, then please guys, don't discuss assertions relating to SOFP, but discuss assertions relating to transactions. And also depreciation, of course, will be same with intangible assets. So intangible assets is a statement of financial position, but additions and disposals to intangible assets would be seen as statement of or seen as a transaction. And also remember, intangible assets has amortization, and amortization is also a transaction because it's in your statement of profit and loss. What else? I think that is it there. Then investment in shares is again your statement of financial position. Refer to these pages. So you can just go refer to all of these pages. But the movement in your investment is seen as a transaction. So just make sure when you read the scenario, you know what you're dealing with. Are you dealing with the movements? Are you dealing with additions or disposals or whatever the case might be? Last but not least, so that is all the cycles, right? Then lesson 10 is additional considerations you have to take now when it comes to obtaining audit evidence. So there can come a point where your audit or your client itself use a management expert. So they use their own expert, maybe when it comes to investment property, maybe because remember your client will know how to evaluate their property. So they will get a evaluator to come evaluate their property for them. So that is when they use an expert. So it's to evaluate the property, right? Now, as an auditor, you must see whether you can place reliance on your management expert by evaluating the management expert's competency, capabilities, and objectivity and independence. Because remember, the evaluator can be a buddy of the client, maybe of the CFO, CEO. Then there's objectivity issues. Then as an auditor, you can't rely on the client, on the evaluator, on the management expert. What you can do is, of course, with the agreement with your client, you can then get your own expert. It's called the auditor's expert. So then the auditor will get their own valuator to come and value the property, for example. So that's the difference between the two here. So the one is management gets their own their own expert to evaluate the property, whereas the auditor will then now to just make sure that this property is the value. That's how if you can't rely on management expert. But if you're happy that the management expert is competent, they're capable, and they're objective, then you as auditor must now obtain an understanding of their work. You have to evaluate the appropriateness of that evaluator's report, for example. So you'll recalculate whatever stated in that report. You will determine whether the assumptions used in that report is fine. And of course, you'll use professional skepticism throughout this process. You don't just accept the work of the evaluator as face value, because you still have to determine whether you can rely on its work. Then the auditor's expert is just now the auditor appoints an expert to be able to obtain sufficient audit evidence. Because, like, remember, auditors is not an expert in everything. So, like, we're not valuators, so we would end up needing a valuator if we didn't know what is the value of a property, or a geologist, or an actuary, or whoever. So then, but before we can also rely on our own expert that we self-appointed, we have to go see. We first have to determine the need of the expert, the competency, and as well the objectivity, because there must be someone that's objective. But at the end, the auditor still remains solely responsible for providing the audit opinion. So the auditor must still go make sure that whatever the expert said is still, like, you still go evaluate the work. Okay. Then auditing accounting estimates that involve subjectivity. So estimates is all about allowance for credit losses, where we went through, whereas subjective as an estimate is like 5% of the total trade receivables. Warranty provisions, fair value measurements. So fair value would, for example, fall in line with investment property. So anywhere where there's estimates required. So the procedures there that you must do is you must assess management's judgments. You'll assess the data, the assumptions used, the consistency. So for example, you'll see, did they use the same percentage in prior year, or is it different? And so forth. Is there policy in place for this percentage? Because if there's a policy in place, you will also inspect the policy. Then related parties. Related parties is if for example, this group of companies, like a holding company and subsidiaries, or joint ventures or associates. This is now group accounting. Those are seen as related parties. Or if key personnel is related to someone else where they have business with, is seen as a related party. So, for example, the CEO or the CFO is friends with one of the or is the wife of a supplier, that creates a related party transaction. So it's important for us to understand related parties, because related parties means that, what is the risk here for related parties? The risk is that they might not sell at market value. They call it at arm's length. So as an auditor, we need to identify all the related parties that this company do have. And when we do look at transactions and balances with related parties, we must ensure that it is at arm's length and it's not like a booty story here. And it, so, and how do you know it is a related party? So you'll inquire with management of all the related parties there is. You can inspect the CP that that where they register the companies. I don't know what to call it, the CPIC. You can inspect that or that online to see if there's any related parties in there. You can inspect meeting minutes, directors meeting minutes for any related parties. So there's a lot of things you can inspect to also identify related parties, and so forth. And because remember, with related parties, there can end up being fraud happening and stuff. And so therefore we want to know who's the related parties and whether there was any transactions done with related parties. And also, as an auditor, one of the procedures is we must make sure related parties is disclosed appropriately according to the accounting standards, because you have a note in the financial statements that says related parties. Then they will say so and so and so is related, and these were the transactions that took place between those related parties. And then of course you must maintain professional skepticism, because for potential management override or manipulation within related parties. So these are just additional considerations you would use. So takeaways, guys. So you focus on understanding the principles and applying them to the practical scenarios. Read the required, carefully tailor your procedures to the specific assertion, risks, and circumstances mentioned in the scenario. Use your how, what, and why formula. Integrating thinking. Remember that all audit concepts are interrelated. For example, materiality, risk assessment, internal controls, and substantive procedures all work together. And then practice, practice, practice. Go work through everything, guys. If I'm gonna show you something. So this is these are notes from you in your lecturers. So if you go on here under your lecturers site, under additional information, your lecturers had your slides. The slides over here come from this. So they were speaking about activity 9.1 and 9.1 and I think 9.2 if I'm not mistaken. Yeah, 9.2. And here they said here questions to work through, which was questions 3, 7, and 8 and 10. This was in their thing. And then this was also another one of them. This was the considerations we discussed now, 10.1 and 10.2. So the use of an expert. So the expert is not the expert in accounting and expert in audit, it's just who appoints them. So the management expert was appointed by your client, and the auditor's expert was appointed by the auditor. And then they speak about considerations about that. They speak about audit estimates here. And they say there which questions to work through to complete. And they say previous tests will be uploaded and so forth. Now, the other thing I want to show you. So this is on page 119 in your TAT 104. So here you can see what question addresses what topic. So please, guys, work through these questions. I was going to work through question 14 tonight, but we don't have time. So I will leave question 14 for tomorrow night, because question 14 touch on I wanted to go through the investment property and a touch on management expert, because remember management expert is relating to the investment property, and it relates to estimates, because remember investment property is an estimate. So there's a lot of fair valuing and assumptions that's being used and estimates being used. I wanted to work through it, but we're not going to work through it tonight because of time. So please, guys, go work through this, and I will work through them tomorrow night on question 14. And then also, what I want to tell you also before we leave, some thinking. I think it's in your, yeah, it must be in your, there's a reason why your lecturers have this here also, because this is a question that is very poorly answered by students. And this, so receive, so debtors, so trade debtors, right, and trade creditors can have a debtors recon and a creditors recon, right? So in the past, UNISA did ask a question where they told the student to formulate substantive procedures on a specific debtor. They said on debtor, say debtor A. You know what students, when you go give them? Students gave UNISA the order procedures to audit the balance of all the debtors. You're going to get no marks. When you're answering a question on substantive procedures on a specific debtor or a specific creditor. So if they're saying do a substantive procedure for creditor X or for debtor B, then you must only order that specific debtor or creditor. And how do you order that debtor and creditor? Remember, you have a debtor or creditor statement for that specific. So you're going to say, inspect the debtor statement for debtor XYZ, or inspect the creditor statement for creditor XYZ. Make sense? And then you say, so you inspect it for the balance on the what you call it on the statement, and you agree to the general ledger and the and the creditors ledger or the debtors ledger and to the finance. Okay, but it won't be in the financial position, because what do you see in the financial position? You see the cumulative amount. You'll see the 10 million rand for creditors or debtors. You won't see that specific data in there. You only see the specific data in the debtors ledger or in the creditors ledger. But if it doesn't agree, you have a recon. So, for example, usually you have a recon for a specific data. Say, for example, I have a debt with Vodacom, right? So, say, for example, the Vodacom statement was issued to me on the 25th of June, right? But I made payment to Vodacom on the 30th of June. So, in the statement of Vodacom will only the statement of Vodacom will show I still owe Vodacom, say for example, 500 Rand. But I paid it after they issued me the statement. So that 500 Rand I paid will show on the next statement. So so as an auditor, if you inspect the Vodacom statement for the 30th of June, which is dated actually that was issued to the client the 25th, you'll see a 500 Rand owed, but in the client's books, you'll see zero balance. And then of course you'll go inquire, and they'll say, no, we did pay them at the end of the month, which just wasn't in the actual statement the client gave or Vodacom gave. It will be in the next time. So as an auditor, you will then go inspect the next month's statement to ensure that that 500 Rand is in the next month's statement, and you're going to go inspect the bank statement as at the end of June to ensure that client did make payment to the supplier. Make sense? So those are the type of procedures you'll do for an individual debtor or for an individual creditor. That is the loss, guys. Makes sense? Very clear. Okay. No questions.
Can I ask about the returns of the trade payables cycle? With trade receivables, we have credit notes, or with revenue, we have credit notes. So in
Yes.
terms of purchases, what are the source documents that would be involved with in terms of returns?
So their supplier will issue them a credit note.
Okay, and then in
Yeah.
our books,
It
okay,
will
we'll
also
also.
seen we'll seen as a debit note because it will just be the reverse of expense. So you remember we debit expense, so the note will be a credit. So the
Okay.
same way you would do revenue, you would then request then for all the I think they call it debit notes, to be honest.
Yes. And then,
Debit notes for the
okay, will it affect our inventory and cost of sales?
yes. So if
Okay.
it's relating to inventory, so it depends. So if it was a purchase,
Mm,
purchase is in your statement of profit and loss, isn't it? So
yes.
then of course it will impact your
Cost of sales.
purchases. Yes.
Yes.
But if it was inventory, for example, if you
Mm,
said debit inventory and credit,
mm,
you see, and you're now
mm.
returning that inventory, then it will impact your inventory. Or it can also impact your expenses, because what if it was a consumable? Makes sense.
Yeah,
Because what
yeah,
if it's not relating to, maybe it was cleaning products, whatever the case might be, then it will
mm,
impact the
the
expense account.
expenses.
Mm.
Okay, and then my second question is on leases. I saw that you said, what must we classify it as a list of transaction or as an account balance?
So let's go back there. Um, I do also just so I don't even know, but I do post these slides also on the eTutor
Yeah,
site. And
yes.
okay, so let me just see. So yeah, let me rather go to the one that I had. So so okay, so it depends, remember?
Mm,
Because if your client is the lessee,
mm,
what is the accounting for the lessee?
mm. My
It's a
client is a lessee.
Yeah, meaning your client is the tenant.
Okay,
So it will be
yes,
a right of use asset and a lease liability, isn't it?
yes,
So the right of use asset will be an asset, isn't it? So that will be a
yes,
statement of financial position. But what does your right of use asset have? Depreciation. So
yes.
that will be a
An
transaction.
expense. Yeah.
Yes.
Okay.
Then your lease liability part of your lease. The lease
Mm,
liability would be a statement of financial position as a liability, but what would be it would be I think finance costs. And that
yes.
is a transaction. Now, what
Okay.
if your lease is a lessor? Because now
Mm,
remember, you're either gonna have an operating lease, you must see is it an operating lease or a finance lease? And you must
mm,
see what would now be, because remember it will be an asset on your from a lessor. So you need to go see what's
yeah.
the accounting. Okay.
Okay. No problem. Thank you so much.
But just go to this page numbers here that I stated here. So
Yeah.
16 to 19 will have that.
Okay. Thank you so much.
Pleasure. Okay. Please explain the audit sampling and when it's performed. Okay. So audit sampling, I think that was in your was all I think audit sampling was in lesson 3, right? But we never touched on it. So As an auditor, you cannot go audit the entire population, right? So, where audit sampling come in is when we calculate materiality. So we use materiality to determine our sample sizes. So for example, we'll take performance materiality, we'll put it in a calculator. So we'll say this is the revenue amount for the year. We'll say this is our performance materiality. Then the calculator will say, and depending on the risk, so we'll say the risk for revenue is high. Then the calculator will then kick out a sample size because maybe revenue maybe the number of transactions for revenue is maybe 5,000 transactions. Then in the sample calculator, by putting in what is the risk factor, meaning it's a high revenue is high risk. So we put the entire population, the amount of rand, the amount in rands. Then we put and say it's high risk. Then we put our performance materiality amount, because based on the performance materiality, it will determine from that 5,000 transactions, how many transactions must we test. Then it will tell us we must maybe test 100 only. And then that's when we will now go and now do substantive procedures on 100 samples only. So then we'll take the sales listing. Like we said, general procedures. We'll first agree the sales listing. We'll cast and cross-cast the sales listing, agree the sales listing to the entire population in the general ledger, trial balance, and financial statements. Then we're happy, okay, the schedule is complete because it agrees to the financial records. Then we'll select our sample based on the sample calculator that said we must test 100. Then we'll either first look at all the material revenue items. So then when we say something material, we'll say everything above performance materiality. So if we calculate the performance materiality as @1 million rand, then all revenue above @1 million rand we will select. And then all revenue below @1 million we will randomly select. So to make up that 100, because maybe that sample of 100, maybe only 20 was above @1 million rand. And then the remaining 80 we will randomly select for all the transactions below @1 million. Does that make sense, Matipi? So you see, now you can see where materiality fits in. So materiality determines what would be your sample size for each and every cycle. So for each,
Yes,
hey, what did you say, Matipi?
yes, it does make sense.
Okay, perfect. Poor. Thank you for the session. Just have class tomorrow. So we'll ask any questions that will arise, which I doubt because of the understanding received so far. Okay, thank you so much. So tomorrow, guys, tomorrow evening, we'll go through question 14 into Tutorial 104. And anything else you want to ask. Thank you so much, guys. Enjoy the rest of the evening, and we'll chat again. Bye-bye.
Bye bye. Thank you.
Pleasure.
Bye.